Stop watching aircraft carriers in the Taiwan Strait. Those are props. They move forward. They move back. They generate headlines. They exist to be seen. Real intent does not move like that. Real intent moves slowly, heavily, quietly. Real intent moves through sovereign debt. Debt is the foundation of the global system. It is not flexible. It is not theatrical. And it is not sold quickly unless something fundamental has changed. So when the second largest economy in the world begins unloading the debt of its primary rival at a pace that defies economic logic, that is not portfolio management. That is exit behavior. At its peak in May 2013, China held $1.32 trillion in U.S. Treasury securities. That position took 2 decades to build. It was assembled bond by bond, month by month, as China's factories flooded the world with goods, and those dollars came flowing back. It was the financial glue of globalization, the closed loop. Chinese goods went west. American dollars went east. And those dollars were recycled into U.S. government debt, which kept American interest rates low, which allowed Americans to keep buying Chinese goods. It was symbiotic. It was stable. It funded U.S. deficits for a generation. As of October 2025, according to the U.S. Treasury Department's monthly TIC report, the Treasury International Capital Data System that tracks foreign holdings, China's official position has collapsed to $688 billion. 16 years of financial integration erased. This is the lowest level of Chinese ownership since May 2009. In absolute terms, China has liquidated over $630 billion in U.S. debt since the peak. That is not trimming exposure. That is not rebalancing. That is a structural withdrawal. That number alone is alarming. But the market environment makes it worse. Throughout late 2024 and all of 2025, the U.S. bond market was in a historic drawdown. The 10-year Treasury yield spiked above 4.5%. Bond prices, which move inversely to yields, were depressed. Anyone selling U.S. Treasuries during this specific window was selling at a realized loss. In the world of institutional asset management, there is an iron rule. You do not sell a depreciated liquid asset at scale unless one of 2 conditions is met. First, you are facing an immediate liquidity crisis and need cash to meet obligations. Or second, you believe the asset itself has become strategically dangerous to hold. China is not short of cash. Despite the collapse of its property sector, despite the deflationary pressures rippling through its domestic economy, China continues to run a massive trade surplus with the rest of the world. In 2024, that surplus exceeded $800 billion. China is not being forced to sell to raise liquidity, so the only logical conclusion is that U.S. Treasuries are no longer viewed in Beijing as a store of value. They are viewed as a liability with a kill switch. That perception has a date. February 24, 2022. When Russian forces crossed into Ukraine, the United States and the European Union executed a financial maneuver that sent a shockwave through every central bank on Earth. Overnight, they froze roughly $300 billion of Russian central bank reserves. Not seized by military force, not confiscated through courts, frozen with keystrokes. Those assets were sitting in Western financial jurisdictions, accounts in New York, London, Brussels. Russia thought that money was safe. It was sovereign reserves, protected by international norms. It wasn't. It became unusable. And Beijing was watching. They analyzed that moment. They wargamed the implications. And they reached a terrifying conclusion. If we move on Taiwan, if the South China Sea conflict goes kinetic, if Washington decides we have crossed a red line, those $688 billion in remaining Treasury holdings are not an asset. They are a hostage. A donation to the U.S. Treasury waiting to happen. The moment sanctions are applied, that wealth evaporates. So China began liquidating. Not recklessly, not all at once, but methodically, persistently, fast enough to matter, slow enough to avoid triggering panic. By October 2025, they had shed nearly $12 billion in a single month. That velocity suggests urgency. It suggests Beijing is less concerned with managing market stability and more concerned with capital flight, getting the money out of U.S. jurisdiction before the door closes. And here is where the story becomes dangerous. When a structural buyer of that magnitude exits a market, basic supply-demand mechanics say the price should collapse. When supply floods in and the biggest buyer walks away, prices fall. In the bond world, when prices fall, yields, interest rates, spike. If market forces were allowed to work naturally, China's exit should have pushed 10-year Treasury yields significantly higher than where they are. That would be catastrophic for the U.S. economy. It would explode mortgage rates. It would bankrupt over-leveraged regional banks. It would make the interest payments on the $36 trillion national debt mathematically unsustainable. But that hasn't happened. Rates have risen, yes. But the market hasn't collapsed. Why? Because the selling did not disappear. It was absorbed. And when you examine who absorbed it, the fragility becomes visible. As China's Treasury holdings fell month after month throughout 2024 and 2025, other line items in the TIC data surged to historically abnormal levels. Specifically, the United Kingdom and Belgium. The United Kingdom's holdings of U.S. debt have surged past $750 billion in late 2025. Think about that. The UK economy is roughly 1/6 the size of China's. Britain does not run a trade surplus. In fact, the UK runs a trade deficit. So where is Britain getting $750 billion to invest in U.S. government bonds? They are not earning it through exports. They are likely borrowing it, or leveraging the balance sheets of institutions in the City of London to act as shock absorbers for the U.S. Treasury market. Then there is Belgium. Belgium's reported holdings now sit at approximately $370 billion. Belgium is a small, wealthy European nation. It does not generate that kind of surplus. But Belgium is home to Euroclear. Euroclear is one of the world's largest international central securities depositories. It is the plumbing of the global bond market. It handles settlement. It provides custody. It creates layers of beneficial ownership that obscure who the actual buyer is. When Belgium appears in the TIC report holding hundreds of billions in U.S. debt, it is rarely the Belgian government. It is custodial accounts. It is pass-through vehicles. It is other central banks and sovereign wealth funds parking assets behind a veil. The surge in Belgian and UK holdings, occurring in exact synchronization with China's exit, suggests something deliberate, a coordinated effort, the G7 quietly absorbing what Beijing is dumping. This is not a free market transaction. This is geopolitical load balancing. But this strategy has a structural flaw. Capacity. China had seemingly infinite capacity to buy U.S. debt because it was the factory of the world. It earned real dollars by selling real goods. The UK and Belgium do not have that capacity. They are already managing their own debt burdens, their own slow growth, their own energy transitions. By forcing them to absorb hundreds of billions in U.S. Treasuries, Washington is effectively draining liquidity from its own alliance structure. It is weakening the periphery to stabilize the core, and that creates fragility. If the UK economy stumbles, as it did during the liability-driven investment crisis in September 2022, when British pension funds nearly collapsed, they might be forced to sell those treasuries to raise emergency cash. If Japan, the largest foreign holder at over $1 trillion, faces a currency crisis and has to intervene to defend the yen, they will sell treasuries to get dollars. When that happens, the bid vanishes, and the U.S. Federal Reserve becomes the buyer of last resort. China understands this. They are playing a game of attrition. Every $1 billion of bonds they sell forces the Western financial system to find $1 billion of liquidity to absorb it. It draws capital away from productive investment, factories, infrastructure, and into the black hole of refinancing U.S. government debt. It is a weaponized sell-off designed to exhaust the financial capacity of the G7 before any kinetic conflict begins. And it is working. What we are watching is a transition. The U.S. Treasury market was once dominated by economic buyers, countries like China and Saudi Arabia, who bought for profit and trade recycling. It is now increasingly supported by political buyers, the UK, Belgium, Japan, who buy for diplomatic survival. Political buyers are not reliable. They buy until their own voters revolt, or until their own currency collapses, or until their own bond markets break. We are watching the reserve asset of the global system shrink from a universal safe haven into a NATO reserve asset. The pool of buyers is getting smaller, the issuance of debt is getting larger, and the gap between the two is widening. That gap is structural pressure. Pressure that builds silently. Pressure that hides behind calm headlines. Pressure that wears down substitutes until they crack. And while the West shuffles paper liabilities among its allies, China is doing something entirely different. It is converting claims into control. When China sells a U.S. Treasury bond, the transaction settles in dollars. The People's Bank of China receives a digital credit. But China does not want dollars. Dollars are the liability they are escaping. So what are they doing with the proceeds from this $630 billion exit? They are moving the money into the physical world: gold, energy, industrial metals, food. These are not financial assets. These are survival assets. Officially, the People's Bank of China has been a continuous buyer of gold for over 18 months. Unofficially, withdrawals from the Shanghai Gold Exchange suggest the buying is far larger than reported. China is using the dollars from bond sales to purchase metal on the London and Swiss markets and shipping it east. Gold has no counterparty risk. It cannot be frozen by the SWIFT system. It cannot be sanctioned away. By swapping U.S. debt for gold, China is moving from credit-based reserves, promises on paper, to collateral-based reserves, metal in vaults. China imports roughly 70% of its oil. This is its strategic Achilles heel. In a Taiwan conflict, the U.S. Navy could blockade the Strait of Malacca and strangle the Chinese economy. To counter this vulnerability, China has been accumulating record volumes of crude oil. Satellite imagery analysis shows the construction of massive new storage facilities, underground caverns, coastal tank farms. Recent estimates suggest China's strategic petroleum reserves now approach 1.5 billion barrels. That is enough to sustain the economy for months, potentially over a year, without a single import. The money funding this stockpile is coming directly from the liquidation of U.S. Treasuries. China's real estate sector, historically the largest consumer of copper for wiring and plumbing, is in depression. Construction starts are down, and yet China's imports of copper ore and concentrate remain near all-time highs. Roughly 28 million tons imported in 2024. If you are not building apartments, why do you need record amounts of copper? Because you are shifting to a war economy. You need copper for military-grade electrical grids to reduce reliance on imported energy. You need copper for munitions production. You need copper for drones, naval systems, electric vehicles. China is cornering the physical inputs of a 21st-century military-industrial base. They are also hoarding cobalt, lithium, and rare earth elements. China feeds 20% of the world's population with only 7% of the world's arable land. This is another structural vulnerability. In response, China has stockpiled grain at levels that defy commercial logic. According to U.S. Department of Agriculture estimates, China holds approximately 60% to 70% of the world's total reserves of corn and wheat. They have enough grain to feed 1.4 billion people for over a year without importing a single bushel. They are trading yield, interest on bonds, for calories, for survival. This is the fundamental shift. A nation preparing to remain at peace keeps its wealth in efficient, interest-bearing instruments like government bonds. It chases return on investment. A nation preparing for conflict converts wealth into inefficient physical stockpiles. Holding 500 million tons of copper pays no interest. In fact, it costs money to store and secure. It has a negative yield, but it has a positive return on survival. China is willingly accepting lower financial returns today to ensure it cannot be economically strangled tomorrow. Western economists mock the trade. They sold at the bottom. They locked in losses. This is short-term thinking. Beijing does not care about mark-to-market losses measured in fiat currency terms. If they sell a bond at a 20% loss, but use the proceeds to buy oil that becomes strategically critical when the Strait of Malacca is blockaded, that is a winning trade. They are swapping fake wealth that can be frozen or inflated away for real wealth that can be burned in an engine or fired from a barrel. The liquidation of U.S. Treasuries is the funding mechanism for this transformation. They are using the proceeds of the old system to build the vault of the new system. This is not speculation. This is data. The flows are visible. China is selling. The allies are absorbing with borrowed capacity. The proceeds are being funneled into hard assets that can survive systemic fragmentation. This is not a collapse signal. It is more dangerous than that. It is a pressure signal. Pressure builds quietly. It hides behind calm markets and reassuring statements. It disguises itself as normal until the substitutes fail, and the substitutes are finite. Watch the custody hubs. When Belgium's holdings stop rising, Absorption capacity is exhausted. Watch currency stress in allied economies. When the yen breaks or the pound cracks, forced sellers emerge. Watch emergency coordination behind closed doors. When the Federal Reserve opens swap lines or expands its balance sheet without a stated crisis, the hidden crisis has arrived. When those signals begin to overlap, the illusion of stability will evaporate. The biggest buyer is not coming back. The system is already adjusting. The only question is how long the substitutes can continue absorbing what the primary buyer is dumping. And once you recognize an exit for what it is, appearances stop mattering. Flows do, because flows reveal intent, and intent reveals preparation, and preparation reveals belief. China believes the system is fragmenting. They are acting on that belief, and the longer they act, the more self-fulfilling that belief becomes. This is not panic. This is recognition. Flows don't lie. Welcome to Geopolitics of Money.